So today we have Alibaba's Q4 earnings release. Now it's time for a breakdown. What did we actually learn? The annual earnings, especially the December period, is typically the most profitable period of the year, so this is why it is the biggest event of the year for shareholders. And I have a lot of thoughts here. I've been holding this stock for about 2 years now, and there's some parts of the business that really genuinely excite me, and some other parts that deeply genuinely concern me. There are all sorts of new technologies here, like autonomous driving, as well as AI being used on the search engines, as well as a thing called digital shelf price tags that adjust the prices in real time to supply and demand. So I'm going to break this video down into two parts: my expectations, which I'm going to record before the earnings release, which is at 12 o'clock, and then I'm going to be breaking down my review after the earnings release after 12 o'clock. That way this video is going to be everything an Alibaba shareholder needs to know about this earnings release. By the way, I've already made a more general video about why now is the time to be greedy with Alibaba, so this video is going to be more focused on the actual fundamentals of this latest earnings release, designed to answer more specific questions like actually how much do we expect Alibaba to make this quarter. Okay, so first off, I think it's worth mentioning Wall Street's expectation of the stock. Wall Street expect Alibaba to make 260 billion Chinese yen in revenue this quarter. Ultimately, whether Alibaba actually hits this or not will not mean a great deal to long-term investors. However, if Alibaba is significantly above or below this, it will probably dramatically increase the volatility of the share price temporarily. So the reason I'm warning you about volatility is it doesn't always make sense, and it doesn't always drive the stock in the direction that you actually want it to. So what I want to do before the release is identify the numbers that I think are going to be the most impactful to the business long term. So not just revenue, but also net income, as well as research and development and cost of sales. And then compare them to Alibaba's most profitable periods for those figures. To this day, despite Alibaba's revenue doubling since then, they still haven't actually reached the earnings from this period. So this is the goal, actually returning to that point in 2019 when we were earning that much money. By the way, guys, I need to let you in on a little bit of sad news. Even if we have our most profitable Q4 on record, there's just simply no way that we are going to be going back to the 2019 share price anytime soon. In my opinion, we are not even close to where we want to be. Now, the first reason for this is if we match Q4 2020, our most profitable year on record, highest in revenue and net income, we still won't be as profitable for the financial year as we were in 2019. From this point here, we need multiple explosive quarterly earnings in order to get back to 2019 levels. The key thing I'm trying to say here is whatever the results, just be patient. In fact, actually, what we're really looking for in this quarterly earnings is not whether Baba can make money. We know they can make enormous amounts of money. The question is, can they keep the money? Alibaba at its core is not a tech company. Well, actually it is a tech company, but at its core it is a retail company. Now, I was actually working in retail before the pandemic, and when the pandemic happened, we actually had to put our entire marketing team on furlough, which meant that we couldn't use them. Now, without Facebook and Google ads, we were deeply concerned that our sales would drop dramatically, and they did. However, what was so shocking was that our earnings actually went up enormously. Now, you can never know for sure, but it seemed like the adverts that were the most successful were the ones that were going out to our already loyal customers. This is actually probably a bigger issue than it might sound to you. Marketing to loyal customers can have 3 devastating effects. The first bit of damage that advertising to loyal customers can do is if you're advertising sales, then it can actually devalue your brand in their eyes. The second way advertising a discount to loyal customers can hurt you is a loyal customer that might have paid full price after seeing the advert will instead pay 20% less. Finally, the third way that advertising to loyal customers can hurt you is you end up giving a bit of commission to the platform that you advertised on. So a loyal customer that may have Googled your product and gone direct through your website, and in that instance you would have given no money away. But if you advertise to them on TikTok or Facebook, they are going to take commission from the sale, and that can actually be a considerable commission. The big problem here is that these 3 major issues all make the revenue look bigger in the short term. So board of directors like doing them to impress shareholders by getting the revenue up. Of course, this is incredibly short-sighted because what we see is revenues going up and profits going down. It's quite easy to spot this, you just need to look at the cost of sales. A good example of when a company stopped doing this recently, in 2017, Crocs got a new CEO who stopped doing all the crazy sales of the foam clogs. The foam clog is super cheap to make, so they can sell them at like 15 quid, and they were frequently doing these crazy 70% sales. The new CEO came in and stopped that. I think Crocs are only ever at like a 20% sale now, and what he did was he stopped producing so much inventory, and as a result the premiumness of the brand has gone up considerably, and they've stopped giving so much margin away. It's now one of the biggest margin businesses in the footwear industry. Sorry, I didn't mean to plug another one of my stocks there. I just happen to know a lot about Crocs because I hold it in my portfolio, but this is not me plugging the stock. Back to Alibaba. The only reason I will allow for earnings to go down this quarter is if R&D, research and development, have gone up considerably. If research and development has gone up, I don't mind this because in my mind that means the money is technically doing what it should be, which is investing in future profits. However, my big concern is up to this point we've only seen the cost of sales go up and research and development has been going down in relation to revenue. So with that said, now I just want to set my baseline expectations. In the absence of any major events, I expect Q4 to be more profitable than Q3. Again, I don't really care if Alibaba aren't making enormous amounts in earnings, so long as those earnings are being invested back into the business, into things like AI and autonomous driving. So before I go watch the earnings release, which I think is happening now, these are the two things I want. I want net income to be above 13% of revenue, and I want net income and research and development to be above 60 billion Chinese yen, which is what it was in Q4 2022. If we hit those two things, or if we don't hit those two things, if we hit the things, I will potentially buy more. I'll decide if I want to allocate more of my portfolio into the position or whether I just want to hold until Q1 2024. If we are below those things, then I'm going to more than likely just hold for the time being. But yeah, then I might need to do some investigating as to where I think the direction of the business is going. So, okay, let's watch the earnings release. Okay, so the earnings are in and they are bad. They are not what I wanted. They did not hit my targets and the margins have actually gone down by a couple percentage points. However, there are some positives here. The $25 billion share buyback, by my calculations, have bought back a 13% stake in the company. So there are things to get excited about here. I am not buying more shares this quarter, but I will definitely be holding to the next quarterly earnings. So before I say any more, I'm going to make a quick cup of tea, move to the other room, and get into all the nitty details. Okay guys, so I started recording this yesterday and it's actually taken me 2 days to go through all of the data on the Alibaba financials to determine what my actual thoughts were. So I'm going to be, before I get into any of the positives from the financials, and there are some positives, the first thing I want to do is go through the negatives. So why we didn't hit the targets that I set in the net income. There's a lot to unpack here because the losses in the net income are not tangible losses, they are intangible losses, and the distinction is really important. So in order for you to understand this, I'm going to walk you through everything step by step. The reason that it's taken me 2 days to understand these financials is because there is a 35 billion won. Sorry, my brain keeps wanting to say dollar, I need to say won, and sorry if I'm saying one wrong, but yeah, there's a 35 billion won gap in their net income, and as far as I can tell, there are two main reasons for this: the losses in Sun Art and Youku. So what are Sun Art and Youku, and how have they hurt the net income so badly? That is the 35 billion won question. Let's start with Sun Art. Sun Art is a retailer, but a really big retailer. So they specialize in superstores, and they have 500 superstores across 211 cities. While Youku is China's, I think, third biggest streaming platform. So think of it a bit like Twitch. It's not important, but both of these were bought by Alibaba in around 2020. Again, getting back to the 35 billion won question, how did these companies hurt our net income? Well, the fact is, they didn't really. We can't know exactly the impact of these companies because both of them fall under Alibaba's digital media and entertainment segment, and you only get the financials for the entire segment, not for the individual companies as a whole. What we know from reading the reports is that the losses in this segment went up to 0.5 billion won, so up 300 million up 300 million won from this time last year. So then I had an obvious question: how remotely does a 0.5 billion won loss remotely contribute to a $35 billion loss? Billion won, sorry. Well, it took me some digging, but eventually I found that on their impairments and goodwill section inside this segment, it stated that the impairments on Youku have gone up 8.5 billion won. In short, this means that 8.5 billion of this $35 billion loss is a paper loss or non-cash loss or intangible loss. Because unless Alibaba actually sell Youku at this much lower price, this loss will never be realized. And the same pretty much goes for Sun Art Retail Group, except instead of Alibaba devaluing Sun Art's brand in the goodwill section, basically Alibaba have stated that the retail estate of Sun Art Retail Group has gone down in value. Basically, China, like everyone right now, is in an economic crisis. They are in a very different crisis to everyone else, and going into this would mean a video in and of itself, while other YouTubers have kind of already done pretty good videos on this. So I'm gonna skip over the economic situation in China right now. Some people are saying that this economic crisis might break the entire world economy. However, so far I have to say all that's happened is that the GDP growth has slowed from 10 to 15% to about 5%. So slowing growth is not a recession. Or should I say, growing slowly is still growing. And according to China's best friend, the United States, China is still the world leader in manufacturing. So even if that stopped being true today, the world is still incredibly dependent on Chinese production. Needless to say, I am no expert on macroeconomics, and personally, I believe anyone that says they are either extremely arrogant or just lying to you to make money. All I know is that right now, people are reporting that real estate in China is dropping in value, and Sun Art Retail Group, who are not a real estate business, own 13.79 million square meters of real estate. Safe to say that if there's a drop in the real estate value, this is going to have a significant impact on their net income or their net tangible assets. However, in my opinion, for companies like Sun Art Retail Group, where the real estate is merely an expense, having real estate drop in price actually makes it easier for them to make money in the long term, since it means they'll be able to open more stores in more cities with less income. Page 19 of that earnings presentation illustrates this nicely. Once you add depreciation and amortization back in to the equation, you realize that earnings are no different than they were a year ago. I think possibly for this quarter, the best figure to look at is free cash flow. We can see that we are free cash flow positive, we are earnings positive, we have made money this quarter. We just haven't made quite as much as I would have liked. There are actually quite a few positives in these earnings. However, revenue across all segments are up. I wanted the operating margins to be up as well, but look, I'm happy with the fact that revenues are up, and also the operating margins in the cloud department are up significantly. Earnings have practically doubled, even though revenues have stayed about the same. And of course, there's the big announcement. Alibaba have put 25 billion US dollars aside in order to buy back shares. Now, when I first read this, I got way too excited because I did one quick calculation and worked out that 25 billion US dollars was about 13% of the stock, and I thought Alibaba were going to be doing this in one go. In fact, I thought they'd already done it in Q4, and once I did a bit more digging, I realized that all they'd bought back in Q4 was 3% of the company, and all they intend to buy is around 3% of the stock annually. And here's another thing, I thought they only had 25 billion US dollars in order to buy back stock. No, they've added 25 billion US dollars. They now have 35 billion US dollars ready to buy back shares, but they do not want to use this all in one go. I think they are prohibited by the Chinese government, but God, that is not something I want to be quoted on. I haven't seen that read in any official places. I've just seen that written casually by some people online. You'll need to confirm that yourself. But they have put what they said in their earnings call was that they want to be able to deploy $12 billion a year in order to buy back 3% of the company annually until 2027. If you do some very, very simple maths, you'll realize that $12 billion is way more than 3% of the company. So what this means is, by Alibaba's board of directors logic, they are anticipating that the future valuation of the company is one in which 12 billion might potentially be 3% of the company. Now, this is probably their upper estimates, but that would put Baba above double where it is today. So for those of you that like to speculate on price, I personally don't, Alibaba's board of directors seem to be assuming that the share prices could potentially go up to 150 before the year of 2027. For those of you that don't care about price speculation like me, what this means, buying back 3% of the shares plus them issuing their 1% annual dividend, is that Alibaba, in terms of equity and dividend, are going to be matching the current 10-year treasury bond yield. But let's not hold our breath for that. If you really want to be rich, you've got to do this.